Our next guest says the budget bill could push the dollar even lower after its worst start to the year since 1973. Let's bring in former Bridgewater Chief Strategist Rebecca Patterson. Rebecca, great to see you. Great to have you on the show. In addition to the spending bill, there are other factors why you see a weaker dollar going forward.
Yeah, well, let's start with the spending bill. We're not at the finish line, as we just heard, but if we get a bill something like what we're seeing today, we're looking at a debt GDP ratio in the U.S. that's going from a current 100%, which is already incredibly high, to something closer to 125% of GDP or beyond that in the next decade. What that means is that we're going to have to issue more and more treasuries to cover these budget deficits along the way. And so if we have more bond supply without the same increase in demand, we're going to have higher borrowing costs, and higher borrowing costs are going to slow the economy. A slower economy, all else equal, is not going to make the U.S. a very attractive place for capital. And that's going to mean less foreign money coming to the United States and less demand for dollars. So you can tie what's happening on the Hill right now in part to what could happen going forward with the dollar.
As it relates to the markets, I guess there's a near-term way of looking at a weakened dollar, and that is good for multinationals, good for the stock market. But longer term, obviously, slower growth is negative. So how do you sort of parse this out in the context of we are at record highs in the S&P 500 and we are looking a little bit oversold at this point? Overbought, excuse me.
That's okay. So, yeah, the dollar on a trade weight basis, so it's against a basket of counterparts, is down about 10, 11% year to date, more so against specific currencies. So it's weakened a lot already. I think it started from an overvalued place. So there's more it could fall before the dollar becomes absolutely cheap. You're right to say that historically a weaker dollar has been good for multinationals. I would caveat that a little bit, though, because the big companies have very sophisticated hedging programs. They try to remove as much as possible of currency swings so they don't affect their earnings one way or another. And there's also a causality issue. Historically, yes, earnings per share growth speeds up with a weaker dollar. However, you have to think about what's causing that. If the Fed is cutting interest rates and that weakens the dollar and lifts growth sentiment, that could also lift earnings per share growth sentiment. This time, that's not what's happening. The dollar is weakening a little bit on Fed expectations, but mainly because of a reallocation out of U.S. assets by investors. And we see that in the flow data that's getting reported for the last couple of quarters. So it's not the same cause of dollar weakness that historically has been good for growth sentiment and good for U.S. stocks.
Rebecca, it's Tim. How much of this dollar weakness is also just concern about Fed independence and broader kind of systemic U.S. stuff? And I guess, we've just kind of talked about this. So lead us, though, into who benefits. And you've been investing globally forever. I mean, is it game on for EM, which has underperformed for 15 years?
If we have a weaker dollar and we have worries, to your point, Tim, about putting as much capital as investors have for the last 15 years in the United States, you are seeing some green shoots in places like Germany and Europe more broadly. Not surprisingly, their stock markets are doing much better than the U.S. market year to date. And we did hear from the European Central Bank today that if the euro keeps strengthening to, say, 1.20, that would start to create some concern for them. So I think there are winners in this to a degree. Too much currency strength can be a bad thing. But right now for emerging markets, Tim, I think we have been in a pretty good place. There are some challenges, though, like countries like Taiwan. The Taiwan dollar strength has created headwinds for the country. They're intervening the other way to try to limit it. In Switzerland, Swiss franc strength has led the central bank there to cut interest rates to zero. Hong Kong is intervening to try to protect its currency peg with the dollar. So yes, there are some winners, relatively speaking, but we have to be careful. If the dollar weakness continues, and especially if it's quick, you can lead to some stresses in currency markets that could spill over to other asset classes. I don't think we're looking at a currency crisis tomorrow, but I would keep it on your radar screen that these stresses could build and become less of a winning combination and more of a global instability situation.